In the next 20 minutes, you're going to make your first stock market investment. Even if you've never bought a stock in your life, I'm going to show you exactly which buttons to click, which investments to choose, and how to avoid the costly mistakes that trip up most stock market for beginners. Welcome to the final video in our Stock Market for Beginners series. Over the past 3 videos, we've built a solid foundation. You understand why stock market investing matters, you know the terminology, and you have a strategy for building your portfolio. Today, we're making it real. No more theory, just practical, step-by-step action. By the end of this video, you'll have everything you need to begin your stock market investing journey with confidence. Choosing a brokerage. There are many excellent brokerages available, and most offer similar features. The major ones include, for stock market for beginners, I generally recommend Fidelity or Charles Schwab because they offer robust educational resources and excellent customer support. But honestly, you can't go wrong with any of these major brokerages. All of them offer commission-free stock trading, meaning you won't pay fees to buy or sell stocks. This is a huge advantage. Just 15 years ago, you'd pay $7 to $10 per trade, which made small investments impractical. Remember our examples from video 3. Even $50 or $100 per month can grow into substantial wealth over decades through consistent stock market investing. Opening a brokerage account is straightforward and takes about 10 to 15 minutes. Here's what you'll need. The brokerage will ask about your investment experience and goals. Be honest. This helps them provide appropriate resources and ensures you're not taking on more risk than you can handle. You'll also choose your account type. For most people starting out, you'll want either individual brokerage account, a standard taxable account with no restrictions on withdrawals, Roth IRA, a retirement account where your investments grow tax-free forever, highly recommended if you're investing for retirement. If your employer offers a 401k with matching contributions, max out that match first. It's free money. If you want to invest in individual companies, you need to do proper research. Here's a simple framework for stock market for beginners. Most brokerages provide all this information directly on their platform. You can also use free resources like Yahoo Finance, Seeking Alpha, or the company's investor relations website. Index funds are like buying a pre-made basket of hundreds of stocks with a single purchase. You get instant diversification, low fees, and historically proven returns. This is the simplest approach for stock market for beginners. Individual stocks mean picking specific companies to invest in. This requires more research and carries more risk, but it also gives you more control and potentially higher returns if you choose well. Most successful investors use a combination, a core portfolio of index funds for stability, with a smaller allocation to individual stocks for growth potential. Researching index funds. If you're following the index fund approach we discussed in video 3, you'll want to search for S&P 500 index funds. The most popular options include diversified portfolio of commercial real estate. Warren Buffett has held this stock for decades. Quick reminder, if this series has been valuable, subscribe so you don't miss our future content on advanced investing strategies, dividend growth, and navigating stock market crash events. For a diversified dividend portfolio, we want companies from different sectors that have strong track records of paying dividends. Here's a sample allocation. 1. Johnson & Johnson, J&J, Healthcare Sector Dividend Yield. Approximately 3% dividend aristocrat with 60-plus consecutive years of dividend increases. Stable, defensive business in pharmaceuticals and consumer health products. Congratulations! You are now a stock market investor. You own a piece of real businesses that generate profits and create value. Let's walk through the actual purchase process step by step. I'll use a generic example since all brokerages work similarly. Step 1. Search for the investment. Type the ticker symbol, like VOO for the Vanguard S&P 500 ETF or J&J for Johnson & Johnson, into the search bar at the top of your brokerage platform. Step 2. Review the details. Check the current price, recent performance, and key metrics. Look at the chart to see how the stock has performed over the past year. Read the company description to confirm it's what you're looking for. Step 3. Click Trade or Buy. This opens the order entry screen where you'll specify your purchase details. Step 4. Choose order type. For stock market for beginners, use a market order, which buys at the current market price. Your order will execute immediately during market hours. As you get more advanced, You can use limit orders to specify your maximum price. Step 5. Enter quantity. Decide how many shares to buy. Most brokerages now offer fractional shares, so you can invest any dollar amount. If a share of VOO costs $500 and you want to invest $100, you can buy 0.2 shares. This makes stock market investing accessible at any budget level. Step 6. Review and submit. Double-check everything. The ticker symbol, the number of shares or dollar amount, and the order type. Then submit your order. Step 7. Confirmation. You'll receive a confirmation that your order was executed, showing the price you paid and the number of shares you purchased. For stock market for beginners, I recommend checking monthly at most. The only difference is that most people panic instead of taking advantage of the opportunity. You can set up recurring purchases, say $500 every month into VOO, and the brokerage will automatically execute the trade. This is dollar cost averaging on autopilot. You never have to think about it, never have to time the market, and never have to overcome the psychological barrier of clicking buy during a stock market crash. The system just keeps investing for you, month after month, year after year. Here's how to set it up. Go to your brokerage's automatic investment section, usually under transfers or recurring investments. Choose the investment, like VOO. Mistake number 5, not diversifying. Putting all your money in 1 or 2 stocks is gambling, not investing. Warren Buffett, Peter Lynch, and every other legendary investor has had down years. What separates winners from losers is persistence and staying committed to the long-term plan. I strongly recommend reinvesting, especially when you're in the accumulation phase of stock market investing. Here's why. When you reinvest dividends, you're buying more shares without having to contribute additional money. Those additional shares then generate their own dividends, which buy even more shares. This creates a compounding snowball effect. Most brokerages offer a DRIP, Dividend Reinvestment Plan option. Simply enable it for each holding, and dividends will automatically purchase more shares, often with no transaction fees and allowing fractional shares. Over decades, reinvested dividends can account for a massive portion of your total returns. Studies show that reinvested dividends have contributed about 40% of the stock market's total return over the past century. Common mistakes to avoid. Thank you for watching this entire series. If these videos helped you, please like them and share them with anyone who could benefit from learning about stock market for beginners. Click it now and keep learning. Your future self will thank you for the action you take today. Let's keep building your financial future together. Don't overthink which brokerage to choose. They're all good. Just pick one and get started. This month, make your first investment. Whether it's $50 into an index fund or $500 split across several dividend stocks, take action. The hardest part is starting. Set up automatic investing. Schedule recurring monthly investments to build the habit. Even if you start with just $50 per month, the consistency matters more than the amount. Educate yourself continuously. Read books like The Simple Path to Wealth by J.L. Collins or The Little Book of Common Sense Investing by John Bogle. Follow reputable financial websites. Keep learning.